Okay guys, I'm back again today. I was going to wait until Friday and do a market summary video, but there has just been too much action that's been going on in the markets, so I thought I would do a short video today, throw it up on YouTube, and kind of give you my opinion on what's going on. Basically, we saw the stock market sell-off today, we saw the treasury bond market sell-off today, and we saw the dollar weaker against the Japanese yen and the British pound. Now, there has been very heavy selling going on in the treasury bond market, and in fact today is the fourth trading day that we've been seeing this action. In fact, today took out my estimates for the 10-year. I had in one of my previous videos mentioned that we would probably see the 10-year around 3.5% by early to midsummer, and somewhere around 3.75% by midsummer to early fall, and we almost took out 3.75% today. It seems the treasury bond bubble is quickly deflating, and even with the Fed as a buyer of debt. Now, this can get out of hand rather quickly, and in fact we could even see rates spike to 4 to 5% as early as this Friday. If panic selling kicks in and people run for the exits, we could see rates even higher. Okay, this is a bond market dislocation that I was speaking of. We are not in it, but we are starting to see the signs of weakness in treasuries, and like I said, once people start running for the exits, it could get really out of hand really quick. Okay, and if the bond market is much bigger than the Federal Reserve, and any attempt by them to stop this will only make things much worse. These so-called economists out there that are calling for an end to the recession by the end of this year had better wake up, because if the treasury bond market implodes, it will take the economy and the stock market down with it. And we are on the verge of a full-blown collapse. We really are right there. Rising interest rates will stomp out any hopes of any recovery. And in fact, rising interest rates is what happened in the 1930s. The Depression was caused by a credit market collapse and not by a stock market crash. So be prepared for the worst case scenario. Another thing weighing on the minds of investors is General Motors' inevitable bankruptcy. It will happen. The bondholders have told the Obama administration to take a hike, that they would take their chances in court. Now, this will be closely watched, because if the same crap is pulled with GM bondholders that happened to Chrysler bondholders, you can expect to see treasury bond rates climb even higher. Remember, risk must be priced into the market. If you hold debt, you will want to be well compensated for doing so. And the capital structures, if they're not honored, and again, confidence is going to be completely lost if it hasn't already been so, and you're going to see money flee out of the markets like it did today. When you see sell-off in the stock market, sell-off in treasury bonds, and the dollar, what you're seeing is capital that is fleeing the country. Okay, you're not seeing it go in to any other asset class. Now, I wanted to say that there have been some great comments and questions that I've received, and debate is not only welcomed on this channel, but it is encouraged. I am from the Austrian School of Economics and believe that it is important to let the free markets work. The problems that we're suffering through today were caused by too much interference by the government. Anytime government tries to force the markets or the economy, they create more problems. Now, what I'm going to do is I'm going to end my videos with a question for you. In my video on hyperinflation, I said it was technically possible for hyperinflation to happen here in the United States, but didn't think the government would allow it to happen. So here's the question. How much hyperinflation would Weimar Germany in the 1920s have suffered if they had the most powerful military in the world? Okay, thanks for watching, and I look forward to your answers.